Are we consolidating or are we still in a correction? We'll be asking Gary Wagner on Chart This. As always, Gary joins me from beautiful Hawaii. Hi, Gary.
How are you this morning, Daniela?
I'm cold, Gary, here on the East Coast. Gary, excited to speak to you this week because what a big week. Lots of reports coming out on the world front. We saw the IMF project a gloomy outlook for the world economy, stating that if fiscal cliff happens in the U.S. and euro woes continue, that we could see a global slowdown. Also, the IMF downgrading Africa's forecast, the World Bank downgrading China's forecast, and also Spain downgraded by S&P on Wednesday. So how does this all impact gold, Gary?
You know, it's been really interesting because what I've noticed lately is a true divergence, some of it from what we expected to happen and some unknown effects. And what I mean by that is that my belief initially was that if the Eurozone crisis got worse, we would see people really flock to gold as a safe haven investment. And what we learned really throughout this year is that that does happen, but what also happens is people tend to flock to the US dollar as that safe haven investment. And so what we notice is when the crisis in the Eurozone seems to heat up, many times there's this big flock to the US dollar, which has, of course, an adverse effect on gold. Now, on the other hand, when we look at something like quantitative easing 3 or what the European central banks have been talking about embarking upon, and stimulus in China, that is certainly very, very bullish for the precious metals markets.
But Gary, given the situation in the U.S., are you surprised that people still see the U.S. dollar as a safe haven?
Yes and no. I am surprised that it's a safe haven over gold. I'm not surprised that it's a safe haven over other currencies, except maybe the Swiss franc, but that, of course, is a very, very small country. But there's no doubt we saw a dynamic shift. And just as you say, there are so many things going on in the United States that I believe could put pressure, downside pressure on the dollar. I do get surprised when I see the dollar get so strong in lieu of, say, the euro dollar because of fundamental news that comes out of a detail within the Eurozone crisis.
And Gary, gold has not made new highs recently in terms of US dollar terms, but it has in terms of euro.
Correct. And that's exactly our point, is that whereas you would typically have seen the effect in the precious metals go across the spectrum of currencies, you're seeing them very, very specifically targeted.
So, Gary, how is gold acting today? Is it acting like a currency?
Well, you know, I've always thought of gold as the ultimate currency. And when you look at it in that way, it is absolutely the benchmark by which everything else is relative to. But when you look at the dynamics of the US economy or even the North American economy, when you combine Canada in there, what you realize is that there's still no country out there that has the potential that the US has, that has the ability to produce a GDP of 15 trillion, which matches our tremendous debt, but it's really a one-on-one, and that's quite unusual. We have some of, probably, of course, the most dynamic economy in the world, and that's why I think you still get that flock to the dollar.
And there were also the more positive numbers coming out in terms of jobs last Friday, Gary.
That surprised me.
As it did many folks, Gary. But my question to you today is, are we consolidating or are we still in a correction?
You know, the jury is out in terms of compelling technical evidence. It gives me what I believe to be a definitive answer. It has been acting like both, and one of the things that we're going to look at in today's lesson is how do we distinguish between a sideways or consolidating market and a market that's at a pivot point or a reversal. I would have to say over the last few days, it's been acting more like a market that's still in a small corrective stage. And realize I'm looking for new highs in this market over the next, say, 4 to 6 months now. It's going to stair step up. It's not going to go straight parabolic. It's not going to be a straight parabolic rise up. And so for that reason, these corrections to me are healthy, and it's when we don't get them that I worry about them, such as the case with silver right now.
Gary, and we'll get to silver in a second, but looking at gold, would you be surprised if we saw a $60 correction?
You know, we had an intraday low of 1735, and that to me is a fairly critical area. If it can hold that area, I think we've pretty much weathered the correction. If it goes below that, my next real support level is 1694. So, and that would give you that type of a correction. It is possible. I'm a gold bull, so I tend to believe that it's going to be the lesser of the two, but I'm also a realist. So we have to see if, in fact, the market does begin to continue on this downward path, how will it react at 1735?
And before we get to your segment, Gary, just some thoughts on silver. Some people suggesting we could see a substantial correction with the metal. What are your thoughts?
Well, you know, when we look at the major correction when gold hit 1920 and silver challenged that $50 mark again, we saw, what, a 22% drop in about 4 or 5 trading days in silver. The key to the way silver trades and gold trades is that silver is a much thinner market. So it takes a lot less activity to really push that market. And that's where you get these dynamic rises, and that's where you have the potential for a dynamic fall. Now, silver could in fact fall hard. It has in the past. Will it? I think that there's some dynamics at work that should hold support. But again, it wouldn't surprise me if it did correct at a very rapid pace.
All right, Gary, let's get to your segment now. Thank you.
Today's lesson is going to be on discerning whether a market is at a critical pivot point, meaning a reversal at a top or a bottom, or whether the market is simply consolidating. Now, in the case of gold, we have seen a pattern emerge in which we get real spurts or ascents, new price highs, so to speak, and that is typically followed by a rest period or a period of consolidation. That period of consolidation, in many cases, can be construed as a potential top because they both look very similar. First thing we want to look at is a little bit of historical data so we can kind of frame this and look at the fact that where we are looking for a top in the market, is there any evidence historically that that occurrence has been identified before? As you know, on our last chart this lesson, we were looking at some real strong resistance at about 1800, and it was my belief that if we were able to make it over that point, the key was we would run into some substantial technical resistance. 360-minute chart, cash market, straight candlestick format with the MACD below it. Now, as you can see, the MACD is going into really oversold territory and looks like it's going to cross. Of course, this is very short term. But let me show you something, traders, and all I'm going to do is to compress this chart because I want to point out a couple of areas and the reason I felt we could see some resistance here. We talked about this a little bit the other day, but we have a series of tops here at 1800 that give us historical precedents that each time it rose to this particular area, as you can see right here, as well as right here, that we saw a real top in the market. And when we take a look at the price activity of recent, in other words, the market came and it tested 1800. This is that first test right here. Following that, it made an intraday low that actually took us to about 1735 right in here. That was followed by a nice price ascent, but once again, you can see we have hit some real resistance in that area. Now, I also believe that we have a pretty critical level of support that needs to hold. And that level of support I am looking at in terms of a straight resistance and support area. I've talked about this before, that resistance and support are one and the same thing. If we're on the first floor looking up, we're looking at our ceiling. If we're on the second floor looking down, we're looking at our floor. It's exactly the same structure. So what do I mean by that? You can see that as this market came down, these are our primary tops right in here and here at 1800. But you can also see some secondary tops right here and right here. Remember, here we've got a ceiling. But as the market came down, you can see here we have a floor. So the way that I am looking at it is as follows. If in fact we can see this market hold support in this area, and this being 1740, 1735, my belief is that we're probably forming a base in this area before moving higher and to nice ground above 1800. However, if this particular area, which is 1740, 1735, if it does not hold, my belief is that the most logical point for it to go is going to be our next set of Fibonacci numbers. And let me go ahead and darken those in so you can take a look at that. So as you can see, we've created a Fibonacci retracement from the point in which it really began to take off to this top right around 1800. We've identified this one area, 23% retracement, 1740. The next area would be about 1706. And then the 50% retracement would be about 1678. My personal sentiment is if it cannot hold 1740, the next logical point is just above 1700. But as a gold bull, I believe that there's a real opportunity for us to see this market find support in that area. Now, looking at the other side of the coin and looking at a much bigger picture, this is a weekly chart in Henkin format, and here's what we're seeing. As this market forms a base, you can see that it takes off quite strongly as it really goes from what? Just below or above, call it 1550, 1560 in that area right in here. I'm looking at these bodies just below 1600 here, and then it just takes off and takes off strongly. But take a look at the size of these Henkin candles. They're, in terms of the average, much larger in terms of the body size, one. Secondly, absence of lower wick. That's what we look for. Third, of course, they're green. But look at how small they start to get. And look at this week right now. We've almost got that doji-like candle within there. And what does that mean? Well, it can mean one of two things. You can see a lot of these smaller body candles as a market consolidates right in here. But you can also see them at critical pivot points. Here's one. And of course, here's one. If we take a look at the upside, you'll see it here also. Right before it falls, you see these very, very small candles. So here's the thing. We get occurrences of these types of candles in both a consolidating market as well as a pivot point or a market that is about to reverse. The key to me, and the reason that I believe that there's a substantial chance that we'll see a correction in this point, is because when we take in other factors, and primarily what I'm looking at is this very, very strong top here at 1800. We see the market with this dramatic rise stalling again at 1800. And the fact that when we look at the way an Elliott wave cycle would go, it would be something like this. 1, 2, 3, 4, and then 5. So it is not unheard of to get some sort of a small correction, and in fact, I think it would be pretty healthy. The one thing we do want to be on guard of is the fact that wave 2 corrections can be substantial in terms of the distance it can go. You can look at anywhere between a 23% retracement all the way up to a 61% retracement of this primary move. And let's take a look at how that would factor in and how that would look. Now, I've marked our Fibonacci retracement from a different point. If you notice, I'm going down to this low right in here, 1530, up to our current top, 1800. And you can see 1739, first 1699, 38%, and 1666, a 50%, all the way down to 1634. My personal sentiment is that in terms of retracement strength, if we get one in here and haven't already seen it, should be no deeper than our 38% retracement level or 1700. I think that 1700 should be a very, very strong support level within the market. Now, whether or not we'll see a correction that deep or that steep is something we will have to keep our eyes and ears peeled to in terms of looking at the charts, and we'll see how that unfolds over the next days and weeks to come. You know, we've had such an overwhelming response, a positive response to the chart this show, that over the last couple of sessions, I've been providing Kitco viewers that want additional content to look at these topics in a little bit more detail, an area where they can find some bonus content. And this week is no different. I've just put up a screen print of what our website looks like. For those of you who have been following us, you know that little green box, let me go ahead and circle it. That's what you'll click to go ahead and view additional bonus content. Now, what do we have this week? We're going to do two things. The first thing is I was asked by our Kitco viewers to give you an idea of what kind of system you're looking at behind me, the trading system that I've put together and built. I'll have a small video on that, as well as a video on after the show. In other words, this was recorded on Thursday. We will be airing, of course, on Friday. So if there's some additional insight between now and then, you'll be able to see that by looking at the additional content.
Thank you so much, Gary. And you know what I ask you each time?
What's that?
Do you have more in store for us?
There's always more in store.
Thank you so much, Gary. And thanks for watching this edition of Chart This. You can email us any questions or comments at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.